Unless you've been living under a rock recently, you'd have been hard-pressed to escape the news about the Silicon Valley Bank collapse.
Silicon Valley Bank.
Silicon Valley Bank.
The black swan types like that was at the Silicon Valley Bank that did stupid things.
Has this financial dog egg made a buying opportunity this side of the pond though? Before we look at that, let's take a quick look at what happened to SVB and if the same thing could happen over here. So what did happen with SVB? Basically, they didn't heed the wise words of George Bush.
Fool me once, shame on you. If fool me, we can't get fooled again.
What led to their downfall was painfully similar to previous bank collapses. Essentially, customers get wind that their money might be at risk due to the bank investing in high risk or volatile assets. In this case, bonds, which don't fare well with high inflation, and recent months have served up nothing but high inflation. With customers fearing that their choice of bank was riskier than a fart at a funeral, they began withdrawing funds. When this started becoming tricky, it increased the panic, leading to customers trying to withdraw more cash than the bank had available, leading to its collapse. This collapse sent shockwaves through the banking sector, not just in the US but globally. When a big bank like this fails, it makes people look at the financial institutions they've invested in and take stock, or sell stock to be more accurate. A lot of UK banks have seen their share price tumble since SVB's collapse, but is the reaction to UK banks justified, and has this opened up a buying opportunity? First, let's take a look at Barclays, ticker name BARC. The share price lost 30 pence in around a week, which is quite a chunk when it's trading at around the 140 pence mark. Looking at the share price over the last year or so, you could say that it currently looks like a bargain, and the reaction to the US banks has been an overreaction, as the UK banking regulations are a lot stricter after the more recent financial crashes in the UK, so I could see where the temptation is here. If you look at the share price over the longer term though, it paints a much bleaker picture. The financial crash of 2008 saw the share price slide significantly, and it's never really gone above 50% of the price it was before the crash since. Bank stocks are always a risk, so for me I wouldn't buy for the short term, as the volatility of them means that it could potentially take some time to see a profit. With such uncertain times, it does feel like the next big meltdown is just around the corner. Where I do see value for them though is over the long term, as the dividend yield is healthy, currently around the 5% mark with a very healthy coverage of around 4 times. This means the dividend should be fairly safe, as generally a cover of 2 times is seen to be healthy. Like I said, bank stocks are seen as risky options, so they may not have a place in your portfolio, but if you want to take a little risk, you can always cost average your way in by buying little and often and setting a ceiling price. I have been thinking of adding bank shares to my portfolio for some time now as a way of diversifying, and now may be the time. Let's take a look at another one though and see if it's a better option. Lloyds Banking Group, ticker name LLOY, have mirrored Barclays pretty well with their performance over recent years and have struggled to bounce back from the 2008 crash. This shows to me the problem with bank stocks, as a slow recovery is quite a common problem, so it could potentially stunt growth moving forward. The share price also fell after the big crash in 2008 to a scary low of just 23 pence. The bonus with such knee-jerk reactions to global problems that absolutely tank the share price means that it does present with more buying opportunities, and I think at the current price this is certainly one of those times. Lloyd's share price has looked cheap for a while now, with a 13.5% return on equity. The majority of Lloyd's customers are retail customers, so generally hold smaller totals and accounts compared to the businesses that SVB specialised in. We've not seen a major retail bank collapse in the UK for some time. The last major one was Northern Rock, and they were nowhere near as big as Lloyd's, and Lloyd's also have a far better coverage for liquidity. Their financials look strong, and with the dividend covered 3 times over, that brings some comfort, but of course it isn't all rosy. We are in a cost of living crisis, and that will likely affect the bank's profits for the foreseeable future. I think the question you really need to ask is, has this downspin been a bigger blip than the likely problems you can see on the horizon, and have these factors already been priced into the share's value? I think that is basically what it comes down to. I see value here, others may not. I also see risk, but when dealing with such unknowns there is always risk. That's why we invest, as without that risk there isn't the potential for reward. Let me know what you think down below though, and please leave a like and don't forget to subscribe for future content. Stay safe out there. Peace.